Good morning, everybody, and thank you very much for joining us on this sunny day in Cape Town. I hope everybody's surviving the first 10 hours of lockdown. I know I've already shouted at my kids at least 4 times this morning, so I hope you're faring better than I am. Today, we have Omri Thomas joining us from our best of breed partner, ABAX Investments. Omri is the portfolio manager of the Nedgroup Investments Opportunity Fund, which has the strategy to provide an attractive risk-return profile by using instruments which should offer an asymmetric prospective return. In other words, the ability to capture upside with a limited downside exposure. Omri, thanks very much for joining us.
Good morning, Rob, and good morning to all the listeners.
So first up, we're going to talk a bit about what's been going on in the market, and then we'll come on to the performance and drivers of the fund before we talk about what we can possibly expect for the year ahead. So Omri, it's been a bit of a surprising week. We've seen the JSE surprise us and closing up as yesterday at up 18%, with the top 40 up 20 for the week. Would you just talk a bit about how much the SA market is linked to events around the world and why there might be this slight disconnect?
Yes, thank you, Rob. Yeah, I think what we've seen is, and it's been true in the past as well, is South Africa gets intensified experience of what happens in global markets. So global markets have been driven by what's happened in the US. I mean, we've seen massive volatility in the US year to date, and we tend to follow. So if the US was strong overnight, we tend to be strong. If it's weak, we also sell off. So maybe just to take a step back and look at the global environment that we've been in and the trading that we've seen on markets. So I mean, as the concerns about the coronavirus started to intensify, initially from a global perspective, it was thought that it was limited to China. As it became clear that it was wider spread, and I think as America realized that it's also a problem in their market, we started seeing a massive sell-off in global markets led by the US. That led to, normally the market acts as a price discovery mechanism. But what started happening is the market started becoming concerned about liquidity, and the market started acting as a liquidity discovery mechanism. So it was indiscriminate selling of a lot of assets, and wherever liquidity could be found to increase cash levels. And the most evident happening of that was when we saw the 1 week where all assets actually sold off, be equity, the risk-free rate, the US 30-year Treasury sold off, and even gold. So there was this rush for liquidity. Now, with the US stimulus package that got approved on Wednesday night, there seems to be a bit of calm has returned to the market, and there's a bit more rationality in terms of trading. Now, why has the market been so strong the last week? Well, the market was starting to anticipate that this stimulus package was going to be approved by the US Senate, and that did come through. So that has provided a bit of a floor for the market.
Do you think it's a bit too early to get excited about this bounce, if you like?
Yeah, Rob, I think so I mean the fundamentals still look quite bleak, even with this stimulus package. And maybe just to put that stimulus package into context, the US GDP, annual GDP, is around about $20 trillion. And the stimulus package is $2.5 trillion. So, I mean, it's almost 10%. It's over 10% of US GDP that's being injected into the market. Now, that is, where's the money coming from? Well, they're already sitting with debt of about 23 trillion. So that's additional debt being added to the US debt burden. So they're definitely borrowing from future generations. But I think as we've seen the coronavirus spreading and intensifying, last night there was another over 10,000 additions in the US. I think we're going to continue to see this volatility that we've seen in the last while. If we look at the Chinese example of how they effectively managed to stop the spread, was by taking very severe actions and enforcing a lockdown. And if you look at the comments from Donald Trump, he says the cure can't cost more than the pandemic. Basically saying that he thinks closing the economy and going into lockdown, it is a much higher economic cost than the cost of lives if you don't go into a lockdown, which is quite a controversial statement.
Is it similar to what we've heard in Spain as well, right? That's the decision they've taken there.
Yeah, exactly. So I think in South Africa, it's very encouraging to see the type of statesman's leadership that Ramaphosa has taken in terms of the way we've addressed the problem. And I think we could come out of this hopefully a bit earlier than some of the developed markets, although the risk here is that it starts spreading into townships, and to prevent further spread is going to be extremely difficult in that case.
And so your view is on the local economy that it is going to have an impact, but it might be, if we can control it, that it will be slightly a shorter term, and then maybe we'll have brighter prospects towards the end of the year.
I think that's, I mean, it's going to be a very dire situation even if we come out of lockdown. And in my view, and what we've seen is a 3-week lockdown is not sufficient. You have to prepare yourselves for probably another period of another 3-week lockdown. Now, the problem with that is, if you think of when our lockdown now started, it's basically after payday. So the consumers are managed to get their last salary check. If it goes in over another paycheck period, so if we extend it by another 3 weeks, it's going to become a really dire situation for a lot of consumers that's not on a sort of a fixed salary or a fixed wage. And it's plenty of South Africans that are there. And I mean, there's plenty of businesses that can't afford to miss another 3-week trading cycle. I don't know how many of you heard it. It's you can find the recording on News 24 as well. I see they've listed it there. But the CEO of Edcon, Grant Patterson, yesterday phoned all their creditors and to say that unfortunately they've only got enough cash to be able to pay their salaries and not to be able to pay any of their suppliers or creditors. And he doesn't think, or he doesn't know whether they'll be able to get trading again once the 3-week period ends. They'll probably have to go into business rescue. Now, I mean, that's got a huge knock-on impact on a lot of people. It's the second biggest retailer in South Africa. It's got 17% market share in clothing in South Africa. And I think that's one example of the type of the toughness of the trading that's been experienced. So if you go into the second 3-week period, it's going to be quite dire for consumer-facing companies. You have to have a lot of stimulus and support from government. Unfortunately, we're not in the fortunate position that developed markets are in, that we've got balance sheet capacity to support the economy. We were already constrained prior to going into this crisis. So it's going to be very difficult for them to do a lot. So we be wary to have overexposure to consumer-facing companies.
And Omri, you touched on the government situation now, or the fiscal situation. The portfolio holds some longer dated SA government bonds. They're now yielding around 12%. Can we just get your view on local interest rates, maybe where level of inflation might sit, and also the ability of the government to continue servicing this debt into the future?
Yes, thanks, Rob. So I think, and starting off with inflation, I think inflation is going to be extremely low in South Africa. So there are a lot of deflationary forces, being at the oil price, being at a reduced demand. There's going to be very little demand-driven inflation. So it'll have to come from price inflation, and there it's also difficult to see where price inflation is coming from. Even with the rand weakening, it's going to be very difficult for companies to pass on those price increases to the consumer ultimately. So inflation is going to remain very low. Now, that said, our real rates are extremely high still. So we've seen a 100 basis point cut in the last monetary policy committee meeting. And I think relative to the rest of the world, we've still got ample capacity to cut rates further. So I won't be surprised to see further 1 or 2 interest rate cuts soon. We need all the help that we can get to get the local economy going. And I don't think a rate cut or 2 will be inflationary. And I think what we've also seen is the unprecedented move that our Reserve Bank has also discovered quantitative easing and started buying back government bonds as well. Now, the 12% yield, it's quite an attractive real return if you consider that inflation is going to be maybe 3 to 4%. Relative to the rest of the world, it's a very attractive return. So if towards the end of the year, and it's very difficult to say, but if you get to a scenario where the market can start seeing that the virus is being contained, or the daily infection rates are decreasing, that the recovery rates are increasing, and that the global economy starts functioning normally again, our real rates will look extremely attractive relative to the rest of the world. But I think in the meantime, you're going to see a lot of volatility in our bond yields as well. So I think where historically we thought sort of 9% was a fair value level for bonds, that's definitely moved up, and it's probably closer to 10 to 11% now. So if bonds are yielding 12, it's not a bad buy, but I think we've got a bit of a trading hat on at the moment with bonds.
And sorry, the last part of my question, Omri, was about the ability of the government to continue servicing the debt, especially given that our tax revenues are going to be lower in the next over the next at least year.
Yeah, Rob, we're in a fortunate position that a lot of our bonds are actually rand-denominated bonds, so we can just continue paying the service of the bonds from using our local currency. So I think we will be able to service it, but it will mean that our money supply will increase. But again, as I said earlier, I think in the current environment, that won't be inflationary, so we can probably stomach that.
Okay, thank you. What I'd like to do now is just move on to the portfolio and just talk about a few of the performance drivers over the past, say, since the beginning of the year. And we've recently put out a one-page note that I hope everybody has received or investors in the fund have seen. But elaborating on some of the points on there, firstly, you increased the equity exposure and then specifically the SA equity exposure due to attractive valuations on a large part of the market. And you've talked about this on a number of occasions recently. And in addition to that, you removed protection to gain from the upside or the attractive upside in some of these names. Would you mind just elaborating a bit on that?
Yeah, Rob, it's very disappointing. I mean, as you said in your intro, we've always tried to structure the fund to have limited downside or protect on the downside and give significant upside participation. Now, our view going into this year was that our market's now been under pressure for 5 years. Over 5 years, valuations were starting to look very attractive, and the downside for us was becoming limited. So for us, the upside participation was becoming more of a focus. And so we didn't have much protection over our portfolio. We had protection over Naspers, which was our biggest holding. We had protection over Sasol up till December last year, and that protection worked well. But as Sasol continued to fall, from a valuation perspective, it was looking extremely attractive. Our analysis showed that Sasol was going to earn over 35 Rand per share, and I mean, now the share is trading below what we thought they were going to earn as earnings in a year. So our equity weighting was at a very high point, close to our maximum, and obviously that didn't help when the market sold off. Within that, we had quite a high weighting in Sasol, which significantly impacted the performance. And the third element that was really disappointing was, I mean, we've had this exposure to the Euro Stoxx basket of notes, and two of our biggest notes was now, actually expired now in March, and both those were way above the levels where we participated in the upside, and so a lot of income was already accrued in those notes. Now we've got the capital protection on those notes, but due to the rapid fall, it actually fell below those capital protection levels, which meant that all the accrued value basically disappeared in a space of 2 to 3 weeks. Now some of these were trading at 140, 150 Rand to our original purchase price of 100. So you basically lost 40 or 50 Rand in 2 3 weeks, which was disappointing. So now we're below that capital protection level, and it rolls into future years. But it's very disappointing that you've had that hit to performance in short term. Now, if the market stays here, I mean, some of these notes are now trading at 60, 70 Rand. If the market just stays here, we're still going to get our 100. And so you could look at 50% upside from here, and that only takes you back to the capital guarantee level. If we get back to where we were 6 weeks ago, suddenly some of these notes, then all that accrued value that we've lost will start to return. So it was frustrating that one of our asymmetric return instruments got impacted so much in this last sell-off.
Thanks, Omri. You touched on Sasol there and the fact that you took the protection off. Would you just go into that a bit further and when that happened and what your view was on Sasol, and perhaps move that onto what your view is on Sasol's prospects from here.
Yes.
Yeah.
So we had a high weighting in Sasol, and we had a protection structure over a big part of it. In fact, it was if Sasol went below 400 Rand a share. And that worked very well. That protected our investment in Sasol all the way down to I think it was 300 or even below 300 at the time. That protection structure expired in, I think it was September or December last year. So we got the full value of that protection up to the level when it expired. At the time, our view was that Sasol was getting to a stage where it was looking very attractive from a valuation perspective. And the reason was the Lake Charles concerns that were there was basically behind them. They were starting to commission Lake Charles. Our view was that they were going to generate up to $1 billion of free cash flow from Lake Charles. And at that point in time, it was valued at zero in our view, or very little in the Sasol share price. Now, just to put into context, just on Lake Charles, Sasol spent about 180 Rand per share. Now, they overspent on it, but it remains one of the lowest cost integrated chemical plants in the world. So it's a great asset. It was a poor project because of the overcapitalization, but it remains a great asset. Now, what we didn't anticipate to happen is that you get a supply and a demand shock at the same time. So the demand shock led by the coronavirus, which took the oil price down significantly. And then secondly, a supply side shock with both Saudi and Russia increasing production to the current position where we estimate that there's over 3 million barrels a day of excess production, which places a significant pressure on the oil price. In fact, if you can buy oil and store it somewhere, you're going to make about a 50% return just from your physical oil if you're able to store it for a year, if you look at where the oil futures are trading. But that being as it is, so at current oil prices, you're going to see significant supply destruction happening of the high cost oil producers, specifically the US shale gas producers, which on average their cost of production is about, the ranges between 45 and 55, average about 55. At the lower end, it's 45. The whole shale gas producers, all of them are currently unprofitable and bleeding cash. 40% of the US junk bond market is shale gas bonds. So you're going to see a lot of liquidations there, a lot of corporate failures, which will significantly reduce supply. So once the global economy starts normalizing again and demand recovers, there's going to be a total lack of supply. And then your low-cost producers will be in a very commanding position. Now, where is Sasol on that cost curve? They at about $35 before the cost-cutting measures that they've said that they're going to put in place. So if they manage to achieve that, they'll get closer to the $30 a barrel level. Now, it's not too far off where the oil price is currently at about $26. The difficulty for them and why it's been under such pressure is that they've got a very high debt level. And so the market was concerned about them having to do a rights issue. And I think what they just should have done is just did a right issue, get it over and done with, and remove that concern from the market and improve their balance sheet. Unfortunately, capital markets have closed up because of this lack of liquidity, which forced them to go to the investment banks and get them to underwrite a capital raise. Now they've got over $2 billion underwritten capital raising. So I think Sasol will get through this difficult period, but they will have to do a rights issue, and the rights issue will have to be a substantial discount to the share price, and that's why the share remains under pressure. Now, what have we done on our side? It's fallen so far that we don't think it's a good thing to sell now, but also due to the high risk nature, we haven't added significant holdings to our Sasol position. We've bought another 0.1% holding in Sasol because we think when the rights issue happens, we will follow our rights at the point in time and then again increase our weighting in Sasol. So that's our current position on Sasol. We think it is too big to fail company in the South African context. It's the equivalent of an Eskom, but we'll wait to follow our rights before we increase our holding there further.
Thanks, Omri. And one of the areas that did well for you in 2019 was the convertible bonds and linked to the PGMs. Do you still holding those, and what's your view there?
Yeah, Rob, absolutely. I mean, that did extremely well for us, especially the Impala convertible bond. We completely sold out of Impala convertible bonds towards the end of last year. So that did very well for us, and we managed to lock in most of those gains. In fact, it went a lot higher than where we sold initially, but now it's at levels way below where we sold it. We've kept our Royal Bafokeng convertible bond, and because that was at the point where it was starting to participate in significant upside. Again, with the collapse in the PGM price, that price has also fallen quite a bit to the level where it now acts like a bond. So we're getting about a 7% coupon on Royal Bafokeng. But should the PGM prices improve, we can participate in some of the upside. So at the moment, it's a very attractive asset to own because you've got the bond paying you coupons. But should there be a recovery, you'll share in all the upside from here. So we continue to hold our position in Royal Bafokeng convertible bond. And the other platinum exposure that we had was the Zambezi Platinum Pref share, which was issued by Northern. And it's not a very liquid instrument, but we've always said that it's such expensive debt for the company that if we ever need liquidity, we will be able to sell that. And when this crisis started happening and there was this crunch on liquidity, we contacted the company and they bought our full holding in Zambezi Platinum Prefs off us at the 2.5% premium to the intrinsic value at the point in time. So we were very happy that happened, because I think if we try to sell that to them today, it's difficult to see them being a buyer given what's happened to liquidity in corporate SA. So I think there is liquidity, and cash comes at a massive premium at this point in time. And any investor or company that's sitting on a lot of cash is in a very good position to pick up assets at very depressed prices. And I mean, you can look across the market, whether it's equities, property, our bond yields at 12 that you mentioned. So from current levels, it's very tempting to say there is so much risk globally, I'm just going to put it all in cash. But our short rates are now so low, and the risk premium in most assets are now extremely high, that I think for investors putting cash to work currently in the market, they'll get handsomely rewarded down the line. The difficulty is, unfortunately, there's a huge invested base already, and I mean the returns have been significantly impacted, and opportunity fund even more so. But I think from current levels, the risk is to exit risk assets at a low point when you can actually get reasonable returns from currencies. I mean, to just give you one example. If you look at something like an ABSA, it's trading at and the same can be said for Nedbank and even in Investec, it's trading at a significant discount to its book value. Now, even if you say ABSA earns zero next year, so the earnings fall to zero, it implies that for the next 9 years, they will still have to earn 5% less per year than they've earned the last year. So very depressed earnings are already priced into the ABSA share price, and the same goes for Nedbank. These banks are trading at levels below where they were at during the global financial crisis. And I think what we've seen in the last week is that the Reserve Bank is willing to step in to provide liquidity to the market, which supported bonds, but which is also very good for banks. So we think there's a lot of value to be accessed in the market at this point in time.
On those comments, have you been making any changes to the portfolio over the last few weeks?
Yeah, so I mean we've made a couple of changes. So we've tried to sell things that have held up relatively well compared to the market. So the Zambezi Platinum Pref would be one. So we've tried to increase liquidity a bit. We've also tried to rotate from lower quality companies into high quality companies. So an example would be when Capitec sold off so heavily, we had no Capitec exposure. We bought both Capitec and PSG and funded it from sales of lower quality banks. I mean, as an example, at this point in time, just its investment in Capitec is worth 120% of the current PSG's share price. So then you get all the other listed assets for free. So that if you include those listed assets, that's worth about 140% per PSG share. And then they've still got quite a few unlisted assets, which none of them material, but it also adds a bit of value to PSG. So PSG looking extremely attractively priced. We've also, as I said, sort of rotated into higher quality companies that we think in this environment will still continue to generate cash, but that's also been sold down as much as the market. So two examples there would be something like a Coronation Asset Management. It's a company that has got no debtors, so it's all cash generative. Now the earnings will be under significant pressure, but it is discounted in the market. They will still generate cash and they will still pay a dividend even in this environment. We've also bought 91, which is the asset management business of Investec, which when it unbundled out of Investec also came under quite a bit of pressure. We think it's one of the best global investment boutiques, and they also continue to generate cash. Just trying to think other changes that we've made. We've had a big weighting high weighting in Truworths, which we saw as one of the better clothing retailers with high return on equity and cash on the balance sheet, a very prudent management over time. We have, given what's happened in the local market, we have started reducing our Truworths position, and then within property, we have selectively increased our exposure to higher quality property counters. But we think the property sector is still under significant risk, and we are going to see corporate failures there because of poor collections on rentals or rent holidays that will have to come through support the SA economy.
And so one last question, and you've alluded to a lot of this value in the portfolio, and particularly the SA equity market. But if you take a step back and you look at the portfolio in general, and I know at times you've built your prospective returns into one slide for us in presentations, where's the embedded value or the most pronounced embedded value in the portfolio, and what can investors expect from the portfolio for the next 12, 36 months without your crystal ball?
Yeah, no, it's very difficult, Rob, because I think we're living in unprecedented times. In fact, we're living in history, which you always do, but it's history that future generations will refer back to and say, look at what happened in 2020 where the coronavirus hit. But if you look at the building blocks that makes up the opportunity fund, and maybe I can start off with the Euro stocks, where we are currently there. From here on, it's your worst case scenario is that you'll go down with what happens with the Euro stocks index. If that market stays here flat for 3, 4, 5 years, on most of our investments we'll get a 50% plus return. And that's if it stays flat. If it recovers to levels it was 2-3 months ago, we'll not only get that 50%, then we'll also get recoup all those coupon payments that we've missed out on. So potentially that return could be somewhere between 50 and 200%. So that part of the portfolio we think is a very attractive part of the portfolio. If we look at the SA equity portfolio, given the hit that the South African equity market's taken, our valuation levels are at extremely attractive levels, and the equity risk premium is now over 10%. So you're looking at a real return or nominal return of inflation plus at least 10%, plus potentially a re-rating in the market. I mean, if you look at our banking index as an example, trading at 2 to 4 PE ratios, whereas historically that was as high as 10. Now, even if we just get back to 6, 7, 8 times price earnings ratio, there's significant upside. Naspers, our biggest holding within the fund, still a massive beneficiary of this global lockdown that we're experiencing, with people accessing online a lot more. And then the fixed interest side of the portfolio, yielding, as you correctly pointed out, 11 to 12%. Again, a real return of 8% plus. So all of the building blocks, other than cash, looks very attractively valued, and the prospective returns look very good. But I think the value of having some cash in this portfolio is that we expect to see continued volatility in the market, and some of these assets you will be able to buy at even cheaper levels. So we haven't used all our bullets. We've still got quite a bit of cash that we can deploy, and we'll look to deploy that in further weakness. But I think you should expect that by within the next 3 to 6 months that that opportunity fund will be quite close to fully invested, because we haven't seen these value opportunities in a very, very long time. It's reminiscent of what the market sentiment was in just prior to 2003, and significant returns were achieved post that. And I think from current levels, the same prospective returns can be expected, but with a lot of volatility in the meantime.
Thank you very much, Omri. We're going to have to leave it there today. I'd just like to end off by saying thank you very much for everybody who attended, and I found that information, Omri, really interesting. Thanks very much. I think you all agree that there's definitely some embedded value in the portfolio, and the prospects from here look encouraging once we come out the other side of however long this lockdown or economic downturn may last. Just a reminder that we have a set of fund manager conversations next week as well, from Monday to Friday. You will have all seen the schedule, starting with Dave Ford on Monday at 10 a.m., technology permitting. And I like to finish by apologizing for any child or animal sounds in the background. I haven't got them under control yet. So once again, thank you very much for joining. Omri, thanks so much for your time today and sharing so much information with us. I think everybody found it really useful.
Thanks very much, Rob. And I think thanks to investors. And I have to apologize for our returns year to date. It's been disappointing for us, and I can just assure everyone that we are really all hands on deck to try and improve our returns from here.
Thank you very much. Once again, thank you, and everybody have a good day.